Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500 and today is Entergy Corporation, ticker ETR. Over the next few minutes, I'll discuss my thoughts about the valuation of this company and its business quality. First up, we have a market cap of $22.9 billion, enterprise value of $46.5 billion. So you see about $24 billion in net debt on this business. That means the debt is over half of the enterprise value, which is absolutely significant. That's a very large amount of debt on any business, even an electric utility company, which we see this is. We'll look at the business description, see if we can learn a little bit more. They engage in production and retail distribution of electricity in the United States, operates two segments, utility and energy wholesale commodities. Utility generates, transmits, distributes electric power in Arkansas, Louisiana, Mississippi, and Texas, including New Orleans, and distributes natural gas. The wholesale commodities segment engages in ownership, operation, and decommissioning of nuclear power plants. So that's one piece here. Interest in non-nuclear power plants that sell electric power to wholesale customers. Generates electricity through gas, nuclear, coal, hydro, and solar power. So basically all the different sources. It's not focused on any one. 24 megawatts of electric generating capacity and 5,000, which is nuclear power. 3 million utility customers across these states. So good piece of information, beta 0.61, relatively low, which means the stock should be relatively less volatile than your average company. It tends to be common for utility companies, especially those that pay large dividends, which I'm assuming this one would. Now, return on invested capital chart. The first thing that I like here is how stable this capital chart is from 2003 to 2011. Look at the year-over-year change in return on invested capital. It is very, very low. 5.58, 5.43. So 15 basis point change. It's very, very little. 13 basis points between 2004 and 2005. And when you look at these, it's like very stable. 6.1, 6.29, 6.2, 6.2, 6.5. So very stable business here. Now that changed a bit in 2012. You see it dips down 3.9%, 4%. And then you had losses in 2015 and 2016. It's not super clear what this is. We'll dive in, see if we can determine it from the financials when we get into that. I don't like seeing losses. It's weird to have these losses in a utility company. Maybe they had some operability problems and they restored it up to this 3 or 4% range. All of these returns are quite low. I mean, even if you look beyond the last 10 years, even in their best years, they're only earning a 6% return on invested capital. You'd really like to be above this 10% line. This is not uncommon for utility companies. They're regulated, so they usually have some sort of limit on the capital returns they're allowed to have. But that's also the biggest downside. So they have stability. They tend to be able to charge a certain price according to their regulations, but then they're unable to actually capture high upside because of that limit on the capital. A lot of these utility companies instantly fall into what I would call an average business. I like this section of the capital chart the most, but of course 2011 was the last year like that, and that was over 10 years ago. The last decade has been quite poor. Return on equity jumps up to 9.6% from the 3.3% return on invested capital. That's that massive leverage that you see there. So it's getting close to the return on equity being acceptable, but it's still really not there. And the problem is when you're paying a price to book here of 1.9, you really need to buy this for book or less. I mean, if you want to earn double-digit returns, you need to be paying less than book value. And this price is twice what you should be paying, which equates to about a PE of 9. And that would make sense as well for a proper valuation of this company because you have revenue growth of only 0 to 1%. If you have a PE of 9, then you have an earnings yield in that 10 to 11% range. Flat revenue growth will give you a double-digit return. But if you're paying for an earnings yield of 5.5%, you get revenue growth of 0.4%, then you're only looking at maybe a 6% rate of return, somewhere in that 6 to 9% range, optimistically. But when you see numbers like this, like declines in EPS over the last decade, declines in free cash over the last decade, that's very bad. Also, you see the assets growing faster than revenue, growing faster than free cash flow, and growing faster than EPS. When that happens, this is what you get. You get lower returns over time, and those low returns are going to really hamper you. And also, when you look at this asset to equity, right, 5.1, that's because you have so much of this business being run by debt, and that debt leverage is also going to hamper your ability to get higher returns, and we're going to dive in more with these statements here. You can see substantial changes in the gross profit line, and that's very concerning. I mean, you see very many years with decline in revenue. It looks like 1, 2, 3, 4, 5, 6 years of revenue declines in the last decade. That's quite poor. I mean, and then you look from 2013, they had 11.3 billion in revenue to 11.7 billion in 2021. The company's not growing at all. When you have a non-growth company with zero growth, literally zero growth, it's very hard to get acceptable returns as a shareholder. So this on its own would be a major problem for me before of considering it. And that's despite the fact that they've managed to grow their gross margin over time. I mean, you see 32% at the beginning of the decade, 41% at the end of the decade. Normally that sort of gross profit margin growth would be very, very attractive. And it's probably why they've been able to get some positive returns, because they've also been able to grow the operating margin from 12% to 18%. And that's why you've seen their EPS go from 476 to 551. They're getting something out of this, even though they're not growing the revenue. But there's only so long you can do that. You can't expect gross margin to now go from 41% to 52% and from operating profit to go from 18 to 30%. It just can't take place forever. And also, this is a peak number. I mean, you have some negative operating years here. You have 9%. I mean, there's some bad years in here. So it's not as predictable even as many utility companies are. And you see they're paying a lot of their money out in dividends, $3.86 in dividends. And what I'm going to guess is there's not a huge gap between dividends and EPS. They're paying, 60%, at least half, but somewhere in the 60 to 70% range of their earnings out in dividends every year. But I'm going to guess that they probably have negative free cash flow when you take into account their CapEx. And so it's just looking poor from both a valuation standpoint and a business quality so far. If you're enjoying this video, hit that like button. Don't forget to subscribe. Ring the bell so you get notified as I upload new videos each and every week. Next up, we have the income statement. So, here's something that's really interesting. Why is the operating expenses growing so much? You went from 2 billion to 3.4 billion when they didn't really grow the business that much. Revenue is flat, but they allowed their operating expenses to go up 70%. When you do that, you're going to get poor returns. You're going to destroy your pre-tax income. This is why, again, the pre-tax income is up a little bit, but it's up 20% over the last decade. 1 to 2% a year is pretty poor. Which means that really the reason that they're able to get the EPS growth that they did is partly because they're paying lower taxes now after the Tax Cut and Jobs Act that cut taxes. Without that, they'd actually have substantially worse returns than they do now. Quite common for these utility companies, you see dilution, 178 million shares outstanding. They end the decade at 200 shares outstanding. So you see that they actually diluted you by about 10% over the course of the decade. That's going to be about a negative 1% modifier on your business. And you can't afford that on these utility companies. Your dilution rate is higher than your revenue growth rate. That is the definition of a company going nowhere from a shareholder's perspective. They might be doing a lot of things internal to the business, but for shareholders, this business is performing very poorly. And this is the other problem. Look at this PP&E. You've grown your PP&E from 26 billion to 42 billion. And yet, where was your cash flow from all this? You're paying it all out to shareholders. We're going to get to cash flow, but I think this cash flow is just coming from nowhere. It's going to come all from debt. Look right here, 10 billion in debt. You end the decade with 24 billion in debt. They have pension liabilities too. With just a disaster on this company. But you've grown the debt by $15 billion. And look at how much the PP&E's gone up, $14 billion. $16 billion. So almost all the PP&E growth has come from debt growth. You can't do that forever. You don't have the returns on capital to justify that forever. The only way it's worked is because interest rates have been rock bottom zero. Once interest rates go above your return on invested capital, then you start have negative cash flow to equity, which destroys the business model. And even with all the PP&E that they've been putting into this business, 1,500,000 here, although you have other, this is a giant amount in other, which makes these numbers really hard to parse. This other number, dwarfs the number of cash flow from operations in a lot of these years. 3.3 billion, 2.6, 3.7, 2.3, 4 billion, 2.8. why are you paying dividends? You can't afford these dividends because your cash flow from operations plus cash flow from investing is negative every single year. You don't have a single year that's positive except maybe 2013. 2013, you could afford your dividend. 2014, you could afford your dividend. Maybe so a 3-year period, you can avoid your dividend. You can afford your dividend. The rest of it, you're negative. And if you average it over the course of a whole decade, you couldn't afford your dividends. You're massively negative. And that's what's happened to the capital structure. You've been diluting shareholders. You've been issuing preferred stock. You've been issuing debt. Every single year, the debt's gone up besides 1 year here in 2015. But basically, every year, the debt has gone up. You can't do it forever. At some point, this is going to retract. At some point, they're going to have to pay back their debt, or they're going to have to stop paying dividends. And it's going to probably happen soon with interest rates rising, which makes it a really bleak future for Entergy Corporation. And for me, that's why I would avoid this company. I think the company is way overvalued. I would not pay more than 8 times earnings for this business. I think that's probably a fair value for the business is 8 times earnings, which means I would want to get it substantially cheaper than that. I would say this is an average business because the return on capital is just poor. You could argue it's a below average business because the return on invested capital is below 5%. And so I would avoid it as a shareholder. And I hope you enjoyed this video. If you learned something, if you like my content, hit that like button. Don't forget to be a subscriber. Join me in my journey as I work through every company in the S&P 500. I've already covered 150 plus. Hit that button at the top of the screen where I have the playlist that's going to pop up for the 150 I've already covered. I think you'll enjoy that set. If you like this software that I'm using, this is quickfs.net. I have the software link in the description below. It's the first link. That's my affiliate link to QuickFS. I think you should check it out. They have both free and paid accounts. And if you use my affiliate link, then I can get a commission. That's a great way for you to support this channel is using my link to sign up. Again, you don't have to pay anything. You can sign up for a free account at QuickFS. Just please use my affiliate link. I think you'll enjoy the software. Thank you for listening. Until next time, stop paying fees, start building wealth.